All right, how we doing, everybody? So what we're doing is basically this is going to be introduction to moving averages. When I go through these moving averages, we're going to have a series of videos, right? There's going to be many of them. So I'm going to take the approach a little bit different because moving averages really does have a level of importance that is significant. I mean, ultimately, there's a lot of trading systems, and over time, it's been proven that the most successful trading systems are based on moving averages. So I'm going to point those out to you guys so that you're aware of them. But ultimately, I want to take a different type of approach where, a lot of times I don't do the baby steps of everything, and baby steps is probably the wrong word. But my point is, I know a lot of you guys do know a lot about moving averages, but I'm going to act as if you don't, and that's going to take some concentration on your part so that you're also not in a position in which you are forwarding it through it a little bit or thinking, well, you know what, I know this or this is no good. Bear with me. Try to listen. I'll try to keep each video on the short side. Maybe not. I shouldn't say that. We'll see how it plays out, but I'll keep some of these on the short side because I want you to make sure you get those concepts, and then we'll move on to another. Pretty simple. What is a moving average? Well, a moving average is, in this case, I'll show you both, right? This is a simple moving average, right? Which means what? In a simple moving average, what we're doing, this white one that you're looking at is the 50 moving average. And the significance of the numbers today won't matter too much. Just going to give some basic information. So what does that mean? That means from this bar to this bar, you take the average close of each, you would come up with a particular number, right? And that number for here is an average of the last 50 days. And that's why it's much lower than where price was. So you say, well, price is up here, the moving average is here. Does that make sense? It doesn't make sense because it's an average of this, all the way from this bar close all the way down to this one down here. So you can see why there's a difference. But the idea, and this is a 200, and this takes the last 200 days. So you can see it's a significant amount of time, right? Now I'm on a weekly chart, so in this case it would be 200 weeks. But I'm just giving you some basic understanding of what that would mean, and you can see I don't even fill the screen. That's how much it is. We can move to a daily, make it a little bit easier, which goes something like this. But the idea, though, of a moving average is to filter noise. The guys that are price action guys only say, oh, you don't need any of this stuff. You may not, right? But the idea is that, yes, ultimately you can tell this is an uptrend, but a moving average will filter noise, right? So if you get the noise of something like this little example here where things are going south quickly, it is true, it was going south quickly, and many people, if you zoom in on this little guy right here that I'm giving you an example of, which was right there, you could say, what would you say market structure was? Higher high, lower low, we're in bad shape, right? But, and we'll learn this soon, the 200 hadn't fallen, so from a longer term perspective, the 200 was still holding. And in fact, that 50 was doing pretty well as well, right? It was doing okay. If we look at something like a 50 EMA, same type of thing. So it hadn't rolled over, which you'll learn about in a moment. But the idea is that it would be understandable if someone said, well, hold on a second, let's just wait and see what happens. Didn't jump the gun on a super short here just based on the fact that market structure said lower low, because it's easy for us to look in hindsight and say, look, it ran, but this was a bleak picture, right? Understandably so. But what you can do is you can filter noise with moving averages, right? They allow you to filter some of this noise and say, wait, we have a level of support coming up here. We're on top of the 200 from a bullish perspective. Maybe we have a chance. And that's the idea of a moving average, to filter noise, to smooth out all the data and give you a little bit different perspective, ultimately in a lot of different views. It also allows you to identify trends and also confirm reversals. What am I talking about? Remember, white is the 50, the red is the 200. That's just what we're working on right now for this first video. It's not the end of the world, but if we just follow along, we see that, hey, going from here, what do we notice very briefly without even having to zoom in? The 200's never even getting touched, right? So this is one heck of an uptrend. The 50 gets tested a few times, right? We could see here there was a trouble spot, right? So in this case, just from a trend perspective, without knowing much, right, we could say that the trend was clearly up. But if we're trying to find out reversals of trend, we could say that, wait a second, in this case, we had the lower time frame moving average below the higher time frame, the 50 and the 200, which are crucial numbers on higher time frames. And we could say, look, from this perspective, it dipped down, so there was a threat of a change of trend. Okay. Now we see there was a big bounce here. Yes, it was. We'll talk about those later. But moving average came back and then lost it again. Okay, so now this would be a confirmation of trend, right? Because now you rolled over, lost the 200, lost it again. So now this is a downtrend. Everyone would agree this is a downtrend. There's a lot of ways to identify downtrends. We spoke about ways to utilize the MACD as well, but this is also a very good way to let you know that, hey, in this type of situation where you have, and we'll go over these rules later, again, I'm just giving you a brief introduction, when you have a lower moving average falling, a higher moving average like this also falling, the lower moving average below the higher, and the low moving average chasing the price, right? What does that mean? The price is falling and it's below the lower moving average and the higher moving average. Said a lot there, right? Well, that's a downtrend. That's the idea. So certainly we don't want to be looking for any longs in this environment unless we're doing a counter trend type play, and that would involve some different things. That would mean, from what you guys already learned, right? It wouldn't even, this is a daily, right? So it wouldn't even be something like H4. That means you would have to be breaking down in here something on H4 as an anchor chart, and if you found a reason, you might take that to H1, the hourly chart, for a counter trend. So that would be the only type of counter trend you would be looking for, and this is the type of stuff you want to learn because this is the key to so much. What is this? Why did I just bring this up? Okay, well, I'm going to show you very quickly because I know a lot of you guys lost a lot of money in this market, right? And something very simple. Now this is 5,200, right? But now I'm going to give you a perspective. We're going to add one more and do something like a 2050. Okay, 2050 is a substantial amount of time. It's not even something low like 1020. 1020 is for pretty aggressive trending, or 821, whatever you want to use. But I'm going to give you some very brief information here. You guys may know this already, but if not, I do want to show you. And what I'm going to do is I'm just going to add this Bollinger Band. Let me adjust it a little bit because the only thing I want to see is that 20. So I'm going to get rid of the upper and the lower part of the band right there in the background. And I'm going to make this very blue and very dark. Okay. So now what I've done is I've added a 20 simple moving average. And if we have a situation where we have a 20 falling, crossing below our 50, we're in a danger zone. Now, you may not short in that situation because for a short, you probably want to see them both heading south, 20 below the 50, which probably happened here. So this leg was a clear sign on this 20-50 type scale. We'll talk about that another day. But the idea, the reason I'm bringing this up is that even on something 2050, which is long-term in crypto land, there is nobody that should have been thinking about a long at this point, right here. Once this occurred and you lost the 20 to the downside, until you had an upsloping at least 20, right, or some counter trend type play, you weren't even thinking about longs. Now, this was a tricky situation. This one was a nice run. This one was a little tricky run where you got a higher high that sold out. But there were some plays to be made in there. But ultimately, once you lost this again, what happens? You got the rollover. Not only do you have a downward 20, which is dangerous, but you also then have that 20 crossing that 50, and this is bear territory again. When you introduce this 200, now you have 20 below a 50, below a 200. We all know what's going on, right? We're in bear market territory. Now there's some marks here that's going up and down and traversing, where there might have been some opportunities in here. We admit that fully, we understand. But the whole point is that when you have these setups specifically, and I'll review them again in detail, this is just a brief introduction to moving averages. As I mentioned, you're going to have a whole series of videos here over this next couple weeks in reference to them. I have them all mapped out. We're good on that. But ultimately, what you're seeing is that kind of setup alone, I'm going to mark them off. This kind of setup here. This kind of setup right there. And this kind of setup right there, right? All these bear crosses are all reason, not only bear crosses, but downward facing 20, price under the 20, right? Those type of things. You have price, I'm going to give you a bigger picture. Price under the 20. This is the price, this is the 20. Downward slope in 20. We can't be thinking about a long, right? So this moment right here in time, no one should have been thinking about going long. There's no reason, right? Then there were some times that we say openly, all right, this would have been your time to play. Maybe you would have been wrong. Maybe you could have lost. I'm completely understanding to that. But when this rolls over again, right about there, you now still have a downward 20, danger zone. Then that 20 crosses the 50, even more dangerous, right? This is a short, a significant short that you could have caught easily because it's a perfect setup. Downward 20, price under the 20, 20 under the 50. And now the entire market under the 200. Granted, the 200 was still rising, but the 200 takes a long time to roll over. And then when that 200 rolls over and you get that same scenario again, same thing, everything's bearish, right? This here, we know what happened. We just all lived it. You had that 20, just couldn't get past the 50. 20 couldn't get past the 50, couldn't get past the 50. And what happens? Complete bear market structure, 20 below the 50, mega dump, right? We all know this was short territory the moment we lost this line. But the idea, and the reason why I want to keep it short is, I made this video a couple times. I wasn't feeling too well anyway, so it's going to come out a lot clearer. But, after doing that, so you know what? Let me break these down, and I want to make them more concise so you guys can focus. So the focus of this video is very short, right? And I just want you to understand, why do we use them? We use them to filter noise to identify trend, okay? That's the key. We want to know that, hey, if we're in a situation where price is below a downtrending line of importance, like a 20-day, right? Well, certainly that is not a situation where you ever look for longs. But we also know that it becomes a certain short, when you have a downward 20 under a downward 50. Get it? We'll talk more about the strategy part. I don't want you to worry about that, but I'm just pointing a couple keys out that these are the elements of a moving average that are significant that you can easily forget. You can easily dismiss those. Now, the other thing is, look, it is a lagging indicator. It's the last point that I'm going to make just on this little video, is that a moving average is a lagging indicator, of course, right? Because it's 20 bars, 50 bars, and it's taking the average. But don't let that confuse you. Now, one thing I will point out, I want to switch this up a little bit. I'm actually going to put them all up at the same time. I'm going to get rid of the 20, and I'm going to show you the 50 simple moving average versus the 50 exponential, right? So what it is that exponential is a weighted moving average, okay? The 50 gives equal weight to all 50 periods, all closes. The exponential is a weighted moving average that gives a little bit more weight to the most recent. Some people like that because you'll end up with your moving average a little bit closer to the price. Look, they're both important. It only matters really to find a lower with a higher, meaning a 50 with a 200, a 20 with a 50, an 8 with a 34, an 8 with a 21, an 8 with a 26. It doesn't really matter. You'll go through, and we'll learn that too, but you go through and you're going to identify the pair of moving averages, or sometimes 3 or 4, whatever you want to use, that makes the most sense for you. And also, a lot of times, it's really about what makes the most sense for the coin or stock that you're looking at. That you might literally find a pair that makes a lot more sense for one versus another. Okay? So that's it. I want to keep it short and concise on this particular video. That's an intro to moving averages. We're going to go so deep on this, but I want you to learn just this basic idea. I want you to take something from it. I literally, even if you know moving average, I want you to truly think about it, because I'm pointing these things out for a very important reason, okay? And I'm going to go through them all much slower, and instead of doing 5 or 6 videos on the subject, I might do 15. Because I'd rather do them short and concisely, that someone can go back to it and say, all right, let me focus on that and see if I missed something, rather than giving you 2 hours in one shot in one sitting. And ultimately, that's key. There's so much more, as I mentioned, and I haven't mapped out how we're going to give it to you, but this is it for now. I want you to focus on that and understand that, hey, a downward 20, I should only be looking for shorts, right? An upward 20, of course, I'm only looking for longs in that environment. An upward 20 with an upward 50, and price, again, the strategy we'll learn, but I'm just trying to get you the idea of understanding, like, hey, those are environments where I'm going to be looking for longs if my moving average is chasing price. What does that mean? In this situation, let me go ahead and just clarify what I mean by that, because I know we're not doing strategy today, but I just want to give you one little clarification. So I'm telling you that, hey, if I have a rising, like this is flat, and we'll talk about that. Flat's okay as well. But if you have a rising moving average chasing your price, what does it mean to be chasing? This is going to be the focus of the next video. To be chasing price would mean that you're in a position to where price is above, right? on buys when we're looking for long. So as long as you have that situation, you prefer it to be closer when possible. You know, if you can get this breakout and you've anticipated, that's okay. It's up to you. Or you would bring this to a lower time frame. But the idea here is pretty simple. In a situation to where you have an upslope, this is a perfect scenario. So it's upsloping, right? If you were looking for a long and you had a situation where it sat on this support and then started to go, fine. Now, it's not ideal that the 50 is coming down. It still was a workable trade because you'd rather be in a situation on a long where you go back here and you say, all right, now my 20 crossing my 50 to the upside. Now we're bullish, and we'll talk about these strategies next time, as I mentioned. But now we're in a situation where price is getting chased by the moving average. The 20 is above the 50. That's all above the 200. And then you can be in a situation and say, all right, I feel comfortable with trend, right? And people will say, hey, I might not even exit this thing until I lose the 20, right? I may not exit until I lose my 50, right? Which didn't happen there either. It's very understandable that someone's taking a 20-50 strategy, just to give you a brief taste of what's coming. They would not have any thoughts of exiting on any of this. Now, I mean, hopefully they got some cold feet around here, but you know, reality is, I guess if they held through all this, they probably held till they got back in this range, and then their exit point would have been right about there, 14,000 or so. When you think about it, if your entry here was in that 4,000 range, there was a lot of reasons to exit for the normal trader. But someone that made a disciplined approach to a moving average strategy held from 4 to 14,000. That's a 3.5 time move there. That's very significant, right? Anyway, that's it for now. I said I was going to keep it short, so I'm going to stick to that. I will talk to you guys soon. This is Mr. Anderson checking out. That was Intro to Moving Averages. We have many, many more coming.